so, and you are over, let's say, working age, usually 16 years old, make income, you are required to file a personal income tax, right? So personal income tax is what we call the 1040. So when everybody asks what is a 1040, basically what they are talking about is your personal income tax. And your personal income tax, there are usually what we call two deductions, which we're going to dive into detail on the next slide, is what we call the standard deduction and the itemized deduction, right? So what is a standard deduction? So everybody qualifies for a standard deduction, right? So usually when you hear some of the, the tax rules, people are saying that, do I take a standard deduction or do I take an itemized deduction? In the last few years, or since one of the things that people mention is that, buy a house, because you're going to get more tax deduction, right? So the trick is that, I wouldn't say the trick, but just to break it down further, itemized deductions are basically anything that includes, and we're going to give you an example, your mortgage, right? Healthcare benefits, and some other deductions. We're going to go through the next slide. But what I want to highlight here is that when your CPA does your taxes, or even you're using a software, whatever it is, what they do at the end is that they compare your itemized deduction to your standard deduction. Whichever is the largest is what they're going to use. And what does the deduction mean? So let's say if you make income of 20,000, standard deduction is usually, let's say, 12,000. Based on your filing status, it's going to determine how much standard deduction we're going to have. And I'm going to walk through the next slides. So your standard deduction is going to reduce your income further. So your taxable income is the money that you made minus your standard or itemized deduction, which puts you in a tax bracket, right? You're going to see all these tables. During those days, the early 90s, accountants, we had to just go to the tax table, see how much money, and look at the line and see, okay, what tax bracket do you belong to, right? That is really going to say how much taxes you're going to pay. So what is going to happen is that it's going to say if you made 10,000, you're supposed to be in this tax bracket. You're supposed to be paid taxes of 3,000. Now we're going to compare the 3,000 taxes that you paid to what you actually paid on your W-2 deduction. If you paid more than what you were required to pay, you get back a refund. If you paid less, then you have to get back. That's what you pay back, right? So that is what it really means in context of what a standard and itemized deduction is. The next thing I want to talk about is business income taxes, right? So what we call, there are a few business income taxes in a form that I'm going to go through. One is called the Schedule C, right? Now you've heard around, what is a Schedule C and who files a Schedule C? If you're an independent contractor, you're a sole proprietor, you are an LLC, you're going to file what we call the 1040 Schedule C. All that is requiring is that it's going to allow you to list your business revenue and your business expenses. The net amount that you make, which is usually Schedule C on line 31, is what you're going to be taxed on, which is going to be called the self-employment tax, right? That's basically what it is. So a Schedule C is a form of business tax, which is I like Schedule C because that's the most simplified version of how you can file your taxes. Remember that if you fall under any of these categories, you don't really require a balance sheet. All you require is your profit and loss, which is the same as the business revenue and expenses. The next form of business tax is called the 1120S, which is an S Corp, right? Which is called the business tax for small corporations. Now, the 1120S is going to require that you provide your balance sheet. It's going to require that you provide your profit and loss. But why do people like S Corps? People talk about S Corps, and I have my theory about that. We can talk about that later. Is that when you talk about an S Corp, the S Corp itself is not a taxable entity. It's a pass-through. What is a pass-through? A pass-through is basically when you list all your business expenses, revenues, in your balance sheet, there's something called the K1. K1 is going to call the shareholders portion of either your net income or your net losses, which is then reported into your personal taxes. So remember that we've got to the Schedule C in the 1120S. All these things end up in your personal taxes. So if you have any of those two, it's going to end up in your personal taxes. Now, the 1120 is what we call the business income tax for corporation. Remember that this is not a pass-through. That's the difference between an S corp and a C corp. Because why? The 1120 as a C corp is taxable, right? The entity itself is taxable. So the only way that as a shareholder you are going to be taxed if you have a C corp is when you pay yourself something called dividends, right, of the company. So dividends is what's going to be taxable. But because the SC corp is not taxable, people can file the C corp and keep the money in it. The IRS wouldn't really care because you're getting taxed on the money. However, in an S corp, you cannot just make profits and keep that in it because you're going to get taxed anyway. And that's one of the things that I try to explain to my clients all the time. Now, the next form of tax is called the business income so tax for partnership, 1065. The 1065 and the 1120S is pretty much the same. The one is shareholders and one is partnership. It all has a K1. It's not taxable, right, on the partnership level. However, individual partners, it's a pass-through, to get taxed based on their K1s, right? So that is why the deadline for filing an 1120S S Corp and a 1065 partnership is March 15th every year, a month before the deadline for your personal taxes and corporation taxes. Why did the IRS make it that way? They made it that way because they want shareholders to have enough time to get their K1s so they can use their K1s to file for their personal taxes. I know this is a lot, and I'm going to pause over there to see if there are any questions before we move on to the next slide, John.
Thank you. We do have a question. Therese Brown. Nana, do you want me to just read her question or you want me to give her the microphone?
Yeah, no, Therese, give Therese the microphone.
All right, let me find Therese and ask her to unmute. Therese, are you still there?
Yes, I'm here.
Therese, please ask your question regarding S Corps and LLCs.
Okay. Hi, everyone. Hi, Nana.
Hi, Therese.
So I just wanted to know, do I have to send 1099s to both individuals as well as all businesses that have paid more than $600?
Yes, that is a requirement. But however, remember that the 1099 is not really a requirement, right? But however, it is recommended. The reason I say that is that because what happens is that anytime that you pay a contractor, right, the 1099 is you telling the IRS that this is how much that I paid the contractor, right? So the IRS take the 1099 and they compare it to how much the contractor is going to file. So as a business owner, I'm always going to advise that you do send a 1099, but there are a lot of companies that may not send a 1099, and that is fine. You have to self-report the amount yourself.
Nana.
Okay, so I'm sorry. So just so I understand, you recommend that I do it on my end, but you're saying that I don't have to send it to them. I just have to report that I paid them.
No, you send them a 1099. What a 1099 does is that, so what a 1099 is that it's not a requirement. You're not required to send it to every contractor. However, it's recommended, right? Because what you're doing is that's your record, that you pay them this amount of money, right? And the IRS is going to take your 1099, and then they're going to make sure that the contractor actually is reporting the income that you've actually reported. That's why it's not disputable. So in short, yes, it's recommended that you do send it. Send a 1099 to every contractor that you work with.
Thank you.
So Nana, I am going to request that you just slow down a bit. This information is very technical, and if you blow by fast, A lot of people can miss it. I know I'm missing
Yeah.
some things when I'm taking notes. So if you could just slow down a little bit for me, that'd be amazing.
Great, got it. So
All right. Next slide.
yeah, so let's go to the next slide, and we can come back to this slide if anybody has any further questions. So this is applicable to everybody, and this is where I want everybody to really, really pay attention, because it really affects how much refund you're going to get or how much taxes you're going to get paid back. So anytime that you file your taxes, and I'm talking about your personal taxes, when it says select your filing status for the year, right? And I'm going to tell you why it is important. So these are the filing status: single, married filing jointly, married filing separately, right? Meaning that you're married, but you and your spouse decide to file separate returns. Head of household. In order for you to qualify for the head of household, you need at least one dependent in your household, right? Qualifying widow or widower. This is what we call the filing status, and your filing status may change year on year. Now, what happens is that, let's say you're single till December 30th, 2020, and you and your boyfriend decide or your girlfriend decide that you're going to go to Las Vegas and get married at 11:50 p.m. on 12/31/2020. Once you get married at 11:55, the whole year you're going to be considered as married. So my point is that your filing status is your status as of 12/31. 12/31 for this year is going to be 12/31/2021 at 11:59 p.m. That is your filing status. And why is that important? That is important because your filing status is going to determine your standard deduction, right? We spoke about standard deduction in the first slide. Now, if you file a single, now this is a 2020 standard deduction. 2021 is going to change, right? But I can tell you one thing for sure, that last year there was a big bump in the standard deduction. I don't expect the same for this year, because different governments have different theories about what they think that adjust the filing status. But as a single person, your deduction as of 2020 was $12,400. You can expect that to increase by $200 or $300. Married filing jointly is $24,800. Head of household, $18,650. Married filing separately, $12,400, just like a single filing. And qualified widow or widower, just like married filing jointly, $24,800. Now, I think I already emphasized why this is important, but I just want to make another point. That remember in those times where people said that, oh, I bought a house, I'm paying all the tax on the house, I'm donating to charity, I'm doing all these things. And I had a client that had a house, a condo, and the charity and all that stuff, but their deduction, which is called their itemized deduction, when added up, was $17,500, and they were filing as a head of household, which was less than $18,650. Right? What does that mean? It means that your CPA, being the pro CPA that they are, is going to default to your head of household, right? Because it has a higher deduction, right? The standard deduction in this sense has a higher deduction than your itemized deduction.
So, Nana, I just want, because now if I'm feeling confused, then other people are feeling confused. So
yes, I know it's a confusing topic.
So the itemized deduction is all the things that you can deduct, like your mortgages, your depreciation operations and all the things that can be deducted.
Yep.
But
Yep. And maybe if you could go to the next slide, I think I have it on the next slide. Example of itemized deduction.
if your itemized stuff, oh, this is the list. If your itemized stuff is less than the standard deduction, then it doesn't make sense for you to do the itemized because the standard deduction will give you more. Is that what you're saying?
No, it doesn't make. The only way that you're going to know that your itemized is less is when you actually do both.
Oh, so you have to do both. Well, if
You have to do both.
If your accountant or your tax preparer is worth any piece of salt, you're gonna do
Yes.
both. That's what
Yes.
you're saying.
Yes, because listen, in the CPA world, standard deduction is the easiest return to do. You don't have to go through all these lists, right? All you do is check standard deduction, and within 30 minutes, an hour, you're done with your return. But itemized deduction is complicated.
So now I'm gonna ask the question that's on everybody's mind. How often do you see, because you do this with your clients, I'm assuming you do both, how
Yes.
often do you see that their itemized deductions are not as high as the standard deduction or the head of household deduction? And if so, could you give me an example of a situation where someone does have a higher itemized deduction so that I could like say, okay, maybe I'm one of those guys, so we got to double check.
Great question. So last year, for the first time, I saw significant amount of itemized deduction that were lower than the standard deduction because the standard deduction was raised significantly as compared to the prior year. Right. So it all depends on what the standard deduction is going to be, and it's going to be something similar to this year. The reason why I say that is just because of the fact that the biggest ticket for itemized deduction, home mortgage interest, real estate and personal property taxes, right? And in some people's instances, unreimbursed medical expenses. But the two biggest tickets is your home. And what we saw last year was because of the pandemic, a lot of people got the deferment for their homes, right? Where they did not really pay, they got a deferment for 12 months for the whole year. You know, when you get your mortgage interest statement of 1098, it wasn't high enough just because you didn't make much payment because you got a deferment, right? So this year,
Wow.
see,
So what was seen as a benefit to homeowners to not
Yeah.
have to pay their loans
yeah,
without being hit on their credit
yeah,
ends up hurting them on the back end
yeah,
on their taxes.
Yeah.
And they get you either way, don't they?
yeah. Yep, that's what it is. You've hit the nail right on the head. That's what it is, because you know what? You're going to get your home at 1098, and you're going to realize that what you paid in 2020 is significantly lower than what you paid in 2019. Or you refinance to a lower interest rate, right? You're going to realize that instead of you paying an interest rate of 5%, you're paying an interest rate of 2-point-something%. It is going to be lower, right? And coupled with that, the standard deduction was also raised, right? So it's I would say that about 60% of my clients who had itemized deduction end up defaulting to the standard deduction. And guess what is great about the standard deduction too? For the first time as of last year, you were allowed to have charitable expense as if you filed for the standard deduction, whereas in the previous years that wasn't allowed. Right.
So is it dollar for dollar on the charitable expense?
Remember, John, all this is doing is that is lowering your taxable income so you can go into a lower bracket. That's all that is doing.
So that I can get a refund.
So that
or not have to pay as much
exactly. That's all that it does.
If you're in that situation. I've never been in that situation.
Exactly.
I kind of want to be in that situation.
Exactly.
That means I'm doing well if I'm paying them, right?
Definitely.
All right,
Definitely.
so I have some questions in the chat.
Okay, let's go.
Regina Brooks asks, can we write off losses from Hurricane Ida as part of the itemized deduction? I thought that was a good question.
Great question. So the great thing about the IDA is that that is going to be what we call the below the line deduction, right? So everybody's going to get it. So far as you're in the disaster zone area, you don't have to itemize the deduction to get it. And that is what the tax. So New York City was one of those that is going to be classified as a disaster area, and everybody's going to get credit for that. Because think about it, it's not going to be fair to those who are not itemizing their deduction if they don't get those deduction credits, right? So that is going to be, once you are demarcated into a disaster zone, you are going to actually be eligible for those as well.
All right. So wait, Nana, hold on. So my business vehicle got flooded out. Now I was paid out by insurance and had to buy a new car that cost more. Do I get to benefit from that in any way?
No, because so think about it, right? Anytime that you check that you are in the disaster area, there's some sort of credit that you get, right? Now you're talking about business expenses, right? So what is going to happen is that, and these tax laws are, they go down the line, right? When you're affected by any disaster, you're going to click yes, right? It's going to click, how much value did you lose? Then you're going to state it. Then they're going to ask you that, were you reimbursed? How much money were you reimbursed by the insurance company, right?
So I wash out. Okay.
yes. You can double dip.
I had to try, Nana. I got another question. For head of household, how long do you have to be head of household in a year? For example, court-appointed custody of a child. Is it like switching from single to married?
Great question. The child should have lived with you at a minimum of 6 months during the year.
6 months to what?
6 months. 6 months or more.
Okay.
That's the criteria. Yeah.
Regina has come back with a question following with the IDA credit. Do you have any sense of what that credit will be? Is there a different credit for personal and business loss?
No,
it's all questions out there, guys.
Yeah, that's a great question. There is going to be differences between those two, both on the personal side and the business side. But remember, Regina, anything that you do on the business side flows directly to your personal side, except if it's a C Corp, right? So if you take in that information, so remember that if you are actually qualified for that on the personal side, technically, it's covering both the personal and the business side. So you can, on the business side, it's going to be called what we call casualties, right? So the casualties, like John, remember John mentioned his example, right? Casualties, they're going to go through various scenarios, right, where they're going to determine what the casualty amount is and determine if you're going to get any credit on the business side, which is going to pass through to the personal side. But on the personal side, the fact that we live in a disaster area, there is going to be some credit that is going to be applied, across board. But that's a very good question. And then again, nobody knows. It's your question that do I have any sense? It's a credit, right? Nobody really knows what that credit amount is. It's not like a number that they're assigned to it, right? I'm not sure if they're going to assign any number to it, but it's just a credit that ends up helping you lower your taxable income and may give you back a refund. But remember, you only get a refund if you pay taxes, right? So all refund is doing is saying that you pay the federal government this amount of taxes, right? And this is the amount that you're going to get back. And how do you actually pay taxes? If you are a business owner, right, and you file a Schedule C as an LLC, you usually don't pay any taxes. So all you're doing is you're reducing the amount of taxes that you're going to pay back. If you are an S corp, right, which I'm going to highlight it on it, I just want to talk about that for a second, and I think it's in the previous slide. The rule of an S corp is that you need to pay yourself reasonable compensation as an owner. What is reasonable compensation? Meaning that you need to be on payroll. If you're earning about $20,000 a month, right? What is going to happen is they're going to expect that you pay yourself at the minimum, somewhere between $5,000 $6,000, because that is the only time that they're able to actually take advantage of the Social Security benefit. And the requirement for an S corp owner is that you have to be on payroll if the S corp is making money. If you're not on payroll, so people say, "Oh, I'm filing an S corp, I'm not going to be on payroll." What is end up going to happen is that regardless of whether you put yourself on payroll or not, there's still going to be a pass through, and that net amount that you make on your S corp is going to be taxed at a self-employment rate, which is higher than the ordinary income rate if you had put yourself on payroll.
Nana, I can't tell you how many clients I talked to last year that have S corps that don't have themselves on payroll because they say they don't want to be double taxed.
Nah.
Like this is oh my gosh, it's crazy because you're not. From my understanding is you're not getting double tax. In fact, you're paying half of the employment tax because you get the half of the employment tax reimbursed to the corporation for paying it as an operating expense.
Yep. So,
wow.
So John, and that is what I just want to highlight on this point because it's important. People that elect for S corp. So somebody asked, what are the benefits really electing as an S corp, right? What are the pros and the cons? So let me give an example. Now, first of all, let me just take a step back and give a recommendation. Anytime that you can go from an LLC and elect as an S corp and come back down to an LLC in the previous year if you don't want to be in an S corp. However, if you incorporate and you elect as an S corp, you can't go down to an LLC. You have to form a whole different company, right? The reason being that it is very expensive to set up an LLC in New York State, just because of the subscription fee and the and what you're going to pay just for the setup. It is cheaper to do an S corp. However, the requirements is different. And I just want to highlight, John, I just want to highlight on this a bit because it's important. If you have an S corp, the real requirement is that you have to do what we call the quarterly federal taxes, payroll taxes, 941 on a quarterly basis, NYS 45 on a quarterly basis. If you do not do that, you're going to get a letter from the New York State. New York State is very quick to write to you and say, hey, how come you don't file your NYS 45, right? Your only excuse better be I didn't make any income, and they're going to be like, regardless of whether you made income or not, you still need to file it because then that is the only time that they're going to actually pay the $25. You're going to pay a $25 fee, right, of what we call the franchise fee.
All right, Nana, hold on. We got back up for a second. So the 941 is a quarterly report that corporations have to send to the IRS reporting the amount of money that they've paid their W-2 employees, correct?
It's payroll taxes, yep.
Right.
So you pay taxes on your payroll.
Right. So now the NYS 45s are the same document, but for New York State.
Exactly.
Correct?
Exactly.
Now, what you're saying is, regardless if you paid employees or not, you still should report these to the entities that are asking for them, correct?
Yes.
All right. Now, I do have a listener or an attendee that is asking you to explain the S corp with regards to payroll requirements for the owners. So can you repeat that you have to pay yourself a reasonable wage for the year and what that actually means?
Yeah. So what that means, and I think John just mentioned it, is that the requirement is paying yourself a reasonable wage. When it's reasonable, the IRS doesn't put any number on it. But reasonable, for me, states that if your company, as an S corp, is making a profit of $30,000, and you're not paying yourself anything as an owner, Now that's going to be questioned, saying that why are you not paying anything? If you're making $5 and you don't decide to pay anything, you can legitimately say that I didn't make enough money to pay myself. Right? Now, reasonable is usually not a specific number, a specific percentage, but we call the eyeball test, right? What do you think is a fair amount? And for me, I don't want to put any number on it, but I can just give an example.
Are you asking me? Are you asking me what a fair amount? If an S corp made $30,000 a year, in profit, what a reasonable amount for me would be? Honestly, I would have to say that I paid myself as the CEO and sole employee of the company at least $10,000. At least.
Fair.
That's me.
That's fair. Yes.
But that's my eyeball. I have glasses on. Some people like taking them off and just guessing. Maybe they're paying themselves $5,000.
Yep.
Is $5,000 okay?
5,000 out of 30,000 to me is the minimum. It's not, to me, I wouldn't say it's okay, but you may not be questions and match. But I will go a little higher than that, to be honest with you. Because guess what, John? So what happens is that if you decide to pay us, if you make a net profit of 30,000, right? You decide to pay yourself 5,000. The 5,000 is part of a business expense, right? You deduct it. How much money are you left with? 25,000.
Right. So you're paying the corporate. You're paying the corporate tax rate on the 25,000.
You're going to pay self-employment tax for the 25,000, which is higher than ordinary income.
So you wouldn't get the corporate tax rate on the 25,000?
Nah, it's self-employment. Remember, S corps is a pass-through.
So then, if that's the case, then maybe I want to pay myself 20,000.
But they're going to take. Remember that they're going to take out Social Security, because that's the only time they take out Social Security.
Yeah, but I get the Social Security back when I retire, right?
Exactly. So it's like, you can't. You spot on. You can't really outsmart the system. It's just that when you do things the right way, you're going to pay taxes. And guess what happens? If you pay yourself and the IRS takes money out, you may be able to get a refund back if your company actually makes a loss, or if you make other losses.
Yeah,
right? Because then,
you got to carry the loss to the next year. You can't get the refund. Where if I'm paying myself, if I'm paying myself 20,000, and I have a family, then I'm definitely getting a refund.
Yeah, and I think I saw something like Jacqueline. Jacqueline, you want to come off mute? And I know this is a very complicated. That's why I want to spend some time and ask a question.
Yeah, I knew we were going to get on this. This was going to be crazy. This part right here. Jacqueline, you want to unmute? Let me see if she's here. Jacqueline Phoenix, is that who it was? Yes. All right. Let me unmute Jacqueline Phoenix. Jacqueline, can you unmute and ask?
Yes, I can, but I'm still trying to understand all this and stuff like that, because I've been in business for over 10 years, and going back and forth with this whole deduction thing is like kind of a bit confusing.
So Jacqueline, when you say deduction, what deduction are you talking about? Maybe you can expand on that a little bit.
Okay, because what it is for me is I'm a sole proprietorship, and I was thinking about going to a LAC. But when it comes down to the taxes part of it, I don't know if I should go up or should I stay where I'm at.
So explain to me. So you said you're a sole prop, right? So you filed what we call the Schedule C, right? Business revenue and expenses, right? Last year. Okay. And so what that happens in that instance is that you're going to get taxed. Your tax amount is going to be based on how much your net income is, right? So if I may guess, what sort of industry what sort of business are you in?
So Tom?
What business are you in? What is your industry?
Childcare.
Okay, great. So what it is that, within the childcare, right, you have a revenue, which is going to be maybe what they pay for the school fees or whatever it is, right? And you have your expenses, which is rent, which is paid the tutors, the teachers, and all that stuff, right? So those are some of the expenses that you need to start thinking about, right?
Mhm.
What is going to happen is that your line 31, which is your net income, is really what is going to determine how much taxes that you're going to pay back. So if you're not really keeping track of your expenses that relates to child care, you're going to be paying taxes on income that you never made, right?
Mhm.
So that is where it's critical to understand what sort of expenses are we thinking about. And what I'm going to recommend, I think, John, we still have that, is that there's going to be a 30-minute free consultation. Maybe we can talk further offline.
Yes.
And we can dive a bit more into your unique situation, just because I would like to see what your schedule C looked like last year. And based on that, I'm going to have some ideas on what I felt like you could have deducted that you did not, and just sort of go through that with you.
Jacqueline, that's an amazing segue, and thank you, Nana, for bringing that up. I just want to let everybody know, please stay on. At the end, I will be giving you guys a survey. And at the survey, you will fill out the survey, and those who fill out the survey will be eligible for a 30-minute consultation with a CPA. Okay? So.
Thank you.
No problem.
No problem.
Sorry, can I just ask Nana a quick question just to make sure I understand? So if you have an S Corp, but you're not paying yourself and paying the quarterly taxes, basically, by not doing so, you're going to be taxed at a higher rate, which is the self-employment tax rate, correct?
You're going to be penalized, but let me take a step back, Jane. You can only pay yourself if you're making income, right?
Right.
So let me just make sure. So if you have an S corp, you're making losses, there's really nothing to pay yourself on, right? So what you should do, right, is that you should still state that you know, if it's the 941, you go to file 000, right? Just to make sure that you're keeping track of it. But you don't have to pay yourself if you don't make enough money. The only way that is applicable is if you make it money, right? Then you need to pay yourself reasonable compensation. My rate is, I always say that just look at how much money the S corp is making, right? If you're making about 10,000 or 8,000 or whatever it is, you want to pay yourself $1,000 or $2,000, that's fair. But if you're making losses, this really is not really applicable to you at that point in time, because your company is making losses and you don't have enough to pay yourself. So when you do file your 1120S, what is going to show is that your revenues and expenses is going to show losses, and those losses are going to carry onto your K1, which is going to flow through to your personal taxes. And you're going to get, if you basically either going to get a carry forward if you just have an S corp, right, losses that you can use to offset future gains, or if you have a W2, right, it's going to offset some of the income that you made and you may get a refund back. So it depends on where you are, but definitely, I just want to be clear that you can only pay yourself if you're making profits.
Right. Thank you so much. And the K1 is acting like the Schedule C.
Yes.
So, okay.
That's an excellent comparison. Yes.
Thank you so much. Thanks,
Okay,
everybody.
so there you go, S corpers and C corpers. If you want to avoid that high self-employment tax rate, make sure you pay yourself a reasonable wage on W-2, so that you can collect that Social Security later on.
And John, the reason why I'm going through this is, and I don't want to sound like, not all CPAs actually are going to tell you this, right? So you as a tax person filing, as a tax owner, you want to make sure that you're going to your CPA with these questions and asking them that, hey, can you let me know when you think I should start paying myself? Or can you let me know what my P&L looks like? So you really need to go to them and really make sure that when they are looking at your taxes, they're not just preparing your taxes, but they're giving you some sort of tax consultation so that what you can do for the following years to come, right? You need to ask those questions. And that is why this exercise is about. We just want to make sure that we educate people enough, right, to actually understand when they submit this information. And I'm going to give an example because of that, because a lot of clients that I've had have confused standard deduction, right, itemized deduction with business taxes. When I say, oh, can you tell us on the business tax they have, and they said mortgage, I'm like, okay, is mortgage on the business or personal? And they said personal. In that instance, those are two separate things. Schedule A is really separate from Schedule C. Schedule A is itemized deduction, which is your personal, and Schedule C is your business revenue and expenses.
All right, Nana.
Right.
We just got a question that I think we're going to touch upon in the next slide. So
Okay.
I just wanna look at time, make sure that we're moving on, and if we can go to the next slide, then we can address the next question.
Okay, let's do that.
All right, here we go.
Okay, so we spoke about this, right? And I'm just going to, highlight it again. Get you ready for your taxes, right? Knowing business income tax form you will be filing. Schedule C, revenue expenses for sole proprietor, independent contractor, an LLC. I just want to add that to that as well. 1120S and 1120 for corporation tax returns for S Corps and C Corps. 1120S, S Corp, and C Corps is 1120. Form 1065 is your tax returns for partnership. Now,
is that for LLCs with more than one member?
So, great question, John. I just want to highlight this. So, let's say if you have an LLC, right, and you have other members on an LLC, right, and you actually decide that you want to actually split the profit, you want to actually give a K1, but you're not an S Corp, but you're an LLC. You can actually file the 1065, right? You can file the 1065 partnership, which is going to give a K1 to every individual member of the LLC. Because all that you're doing is, remember that you're letting the IRS know that there are partners within your company. Right. So that is a great question, John, that I really want to highlight. Because I've had people that have had LLCs and their tax return has been 1065 because they have other partners that they want to actually give a K1 to, and to find a way that they're going to split that up.
But a single member LLC is not going to file a 1065. A single member is going to file a Schedule C, right?
Exactly. Now the next one is, do you have rental income from real estate business? Right. It's a Schedule E, rental income. So Schedule E is rental income. So usually when people come to me and they say, like, Mr. Nana, I want to do my tax for this year, these are the questions that I'm going to ask them. Do you have any rental income? Right? That's Schedule E. Right? Of course you have a small business. Right? The next question is, do you have stocks and bonds? Which is Schedule D, investment and risk. So I just want to take a pause over here. So when you get, this, what's called the Schedule D, right? I know most people are investing, let's say, Robinhood, right? It is actually going to be something that you have to provide to your accountant because that is actually going to be reported on the Schedule D.
But wait, Nana, but isn't that only if you sell? Like, say I bought a bunch of Bitcoin and I still have it. I still got to give you a report on it? Yes, I haven't sold it yet, though, so I haven't made the profit.
Let me. That's a great question, Jordan. Let me say, you still need to. Why? You're not gonna. There's something called realized gains and unrealized gains, right? Realized gains is when it actually affects your taxes, meaning that you actually sold it and made money, and then you're going to be taxed on the money that you've made, right? Unrealized meaning that they give it to you, there's really no impact. However, it still needs to be reported because what you're doing is you're still keeping track of the cost basis, right? Once they give you that, it's called, once they give you that 1099 DIV or 1099R or whatever it is, anything, you actually need to give that to your accountant and leave it to the accountant to decide whether they're going to put, but they need to actually put that in. It's not going to have any income effect, any effect on your taxes, but those need to be reported. If you don't report it, the IRS is going to say, why didn't you report this? It's unrealized, meaning that you're not going to have to be taxed on it. However, that also needs.
Oh, okay. So I just got to tell them, hey, I got $1,000 in Bitcoin. but I
Yeah.
haven't sold it yet.
And
They're not gonna
Bitcoin,
tax me.
Bitcoin is going to give you a statement at the end of the year. Bitcoin gives you a statement.
Or Robinhood gives you the statement of the Bitcoin that you have, right?
Yes.
Now I have two questions on here. One of them I think will be very quick to answer and relevant to what we're talking about right now, and the other one is going to be relevant to Schedule C's. Brenda Braithwaite, I hope I did not mess up that name. She says, "What if I got paid via cryptocurrency?"
That's taxable. Yes.
So how does she report that?
If you got paid, they're going to send you what we call so depending on whatever that it is, right? They're going to either send you a 1099, right? They're going to send you something 1099, and based on that, they're going to show you what the proceeds are, and it's going to be taxable. So remember that anytime that you actually get those amounts, right? And for instance, right now, even if you file in, cryptocurrency has become something that is being highly looked at and being highly audited, right? So just make sure that you're getting that to your accountant once you get to it, and make sure that they do reporting it, because it's definitely taxable.
So they'll send you the forms, and you just make sure your
they'll
accountant
send-
has the forms.
Everything that you have, they have to send you a tax statement. Whether it's mortgage, whether it's crypto, whether it's dividends, whatever that it is, they're going to send you a tax statement at the end of the year.
Okay. And then Schedule E question. Let's say I make $12,000 from my Airbnb room rental. I don't have an LLC. The money gets taxed. I'm spending $2,000 to renovate the apartment. Can I deduct the $2K?
So great question. Let me just clarify. You don't need to have an LLC to have relatives. So remember that when you're making Airbnb, right? So for instance, when you have an Airbnb, what you're usually doing is that you're actually working as a super. You're going to report that on your Schedule C. So Schedule C is going to be tracking your Schedule C's revenue and expenses, right? However, remember that an Airbnb is a business. However, if you have rental income, right? So you need to know the difference between the rental income and Airbnb. So rental income, right? And it can go on the Schedule E as well. It's basically saying that it's reported on the Schedule E, which is the rental income, right? So your rental income is basically how much you rented and what expenses that was incurred on the rental income, right? And based on that, that is going to flow through to your personal taxes. So an Airbnb can also report it on your Schedule E, right? Because that's going to be considered as a rental income, right?
I've seen
So remember,
both. That's a question I wanted to ask.
No,
you
you can't. No, you can't do that. You can't do both. Just do it on the Schedule E, because it relates to real estate. It's rental income.
Because you get it. Some people's tax preparers put it on the Schedule C because they get a 1099.
Yeah, and when they put it on the Schedule C, what is going to happen is that it is going to show up in your Schedule E, but it's not going to be taxed on the Schedule E. So remember that all this is doing, John, is that it's showing you what part of your tax return on your 1040 is going to be reported, but you're going to get tax regardless of where it's being reported.
So he wants to know, can you deduct the $2,000 that he spent renovating his apartment?
Of course, absolutely. And all the utilities and stuff like that got to be deducted. That's part of your rental expense. Absolutely.
Is Airbnb legal for income reporting in New York State?
That I wouldn't have the answer for that. I think that's more of a legal question.
All right. So now you have homework. Now look at that. Okay.
That's more of a legal question, which I'll stay away from at that point. Yeah.
He said, I'll stay away from legal questions. Just give me the numbers. All right. So I'm an independent contractor who did, and if I do not receive a 1099 form, what do I use to report my earnings? How much do I check? Yeah, you have to self-report on your honor, right?
Yeah. Because you know what? What is probably going to happen is that, the person may have reported to the IRS. Because anytime that you claiming income, remember that the person that is paying you is also putting down as an expense, right? So when you put down as an expense, the IRS is going to ask, you paid a contractor, check. Give me the social security number of that contractor. And they put it in as an expense. What the IRS does is they pull up the social security number and make sure that the contractor is also reporting it as income.
And if they don't,
You're gonna get a letter.
what if the letter's lost in the mail? No, I'm just playing. All right, last one before we move on. Nicole Smith, is there a benefit to directing Airbnb funds through an LLC as opposed to as an individual?
No.
No
really.
benefit at all. It
No,
just
not
ends up
really.
on your Schedule C anyway.
Yeah, not really. You can do on a schedule. It just remember all
But it'll be a different EIN though.
But if it's a business, and John, think about it.
And
Everything that we do, regardless of whatever we do with all the LLCs, is going to end up on
the
the
Schedule
1040.
C. So what you're saying is that there's no tax benefit, but that doesn't mean
There's
that
no tax benefit.
legal. That doesn't mean that there's no legal benefit. There might be a legal benefit,
There
right?
might be a legal benefit, yeah.
Hey,
But
you're not going to speak on the legal benefit. That's a different
I just wanna
conversation,
focus-
Nicole.
I just want to focus on the taxes at this point in time, John.
Because at that point, if it's just a legal benefit, now I'm not a lawyer, and I'm going to say that out there right now, Nicole. But the reason I would do that is if someone got hurt in my Airbnb, they can't sue me. They would sue the LLC.
Yeah.
And I would talk to a lawyer about that benefit.
Yeah.
Not a tax benefit, though. Right. Exactly. All right. Cool.
All right, next slide.
Next slide. Wait, we didn't
and
talk about Schedule F.
Yeah, farm income. I want to spend some time on
for all those farms out there in the 5 boroughs.
Yep. I just want to spend some time on not-for-profit, right? Tax exempt
non-profit,
organization,
okay.
not-for-profit. Yeah. So non-profit is very, very, very important. First of all, if you have a non-profit, you need to make sure that you are filing your non-profit on a yearly basis. Else, if you have that exemption, it's going to be revoked. Most important thing about a non-profit is when you do have a non-profit, first of all, the IRS is going to send you a letter and they're going to tell you exactly which of the 990s you have to file. So 990, you have the 990 PF, the 990 EZ, there are different forms of the 990s. So you want to make sure that you go to that letter and knowing the appropriate form that you're going to file. You want to make sure also that you have a working balance sheet and a working profit and loss, as well as making sure that you're capturing all the necessary information for all your grants and your donations. Nonprofit is one of the most complicated tax returns because they ask for a lot of details. Lots and lots of detail. And remember that you cannot file your 990 till you really have, at the minimum, a 3-member board of directors in place. President, treasurer, and secretary at the minimum. You need to have those 3 in place in order to be able to even file it, or the IRS is going to reject it. So I just want to make a note that people will form nonprofit, but there are a lot of, the good about nonprofit is that, you file your yearly taxes. You can also put yourself on payroll and whatever it is. But the income, the requirement to make sure they're tracking, on the grants and the donors and fundraising that you've done is very, very important. So I just want to highlight that, John.
Thank you, Nana. And one more point that I want to highlight is, guys, if you have an IRS EIN letter, scan it and save it somewhere on your computer. Can't tell you how many clients I ask, hey, do you have your EIN letter? That thing? I don't know where it is. Oh, boy. All right. I'm moving on. Next.
Yep. This is the good stuff. Right. Let's make sure that we're going through it because this is important. Now, do you receive PPP, EIDL, grant, or make regular income, wondering how it affects your taxes? Critical. Now, for the PPP, and I think most people that had the PPP last year may already know this, that it is not tax. So basically, the PPP is not taxable. The income on the PPP is not taxable. I just want to take a pause over here and just talk about something when it comes to your P&L in regards to PPP. What I had realized was that, and what has happened for the most part, is that most all businesses recorded the PPP as revenue and as cash
In their books,
in their books.
but not on their taxes, so they can still save it.
No, so the reason I'm mentioning that is that when you're filing your taxes, your accountant is going to ask for your P&L. And guess what is income is included as part of your revenue.
Oh, they got to fix their books.
Exactly.
They got to fix their books, otherwise they're going to tax
you're gonna be
themselves
taxed.
out of money that they're not
Exactly.
supposed to tax.
Exactly. Exactly. That is the point that I want to make. That you want to make sure that you let them know how much of a PPP is included in there, because that amount needs to come out.
Ladies and gentlemen, if you got a PPP and you booked it as revenue, please either fix your books or show the PPP documents to your accountant / taxpayers. You do not want to pay taxes on PPP funds.
Yep. However, the expenses that you use the money to pay is deductible.
That's interesting. How does that work? What's the mechanism that allows that to work?
So this was a great benefit that I've, as accountants, I shake my head. I'm like, this is great because. So let me give you an example. So let's say you have a PPP loan and you decide to pay salaries, right? Now, you're not going to get taxed on the PPP. However, if you pay salaries, remember salary is an expense, right? You're going to get a benefit of actually deducting the salary from your business as a profit and loss as an expense, right? And remember that the PPP demarcated you to use the money for the following, aka salaries at the most 60% to have it forgiven, and rent or other related utilities, right? So those expenses that you use a PPP to pay, you can still put that on as part of your business expenses. This is one of the greatest.
So Nana, I like putting numbers to things and doing like numerical examples of this, right? Say my business grossed 100K.
Mm-hmm.
And because my business grossed 100K, not net 100K, net I probably made like 30, whatever, right? I expensed 70, but I made 100K total. And I got a PPP of $20,833. I'm not taxed on that $20,833, but I could have taken that $20,000 and bought myself a new car for my Uber business with that $20,000 and write off the cost of the car.
So if the PPP didn't have restrictions, that would be accurate. But the PPP has restrictions. Remember, I just mentioned that you need to pay yourself.
But as a sole proprietor, I'm paying myself the $20,000, and then the sole proprietor decides to buy the car.
Yes.
So then I can write that off.
Yes.
But I would have to pay myself first.
Yes. Yes.
I wish I was an Uber driver. That's interesting.
Yes. And that is one of the benefits that a lot of CPAs shaking their head saying that, wow, you're not paying taxes on the money. However, you're able to do the expenses that you use the money for. So remember, the key is that, this is summary, if you are keeping your books, your P&L includes PPP loan, that was forgiven. It doesn't really matter whether it's forgiven or not, but do not include that in your revenue. Make sure you let your accountant or your tax preparer know that. Now let's move on to the EIDL. Remember that under no circumstances should anybody be recording their EIDL as revenue. It is a loan payable.
Yeah, I gotta pay that back.
Exactly. Under no circumstances, so when you get that money, remember those who came to the webinar last time, I think it was last month, John?
Yeah,
right?
it's not
Now,
revenue, it's a liability.
exactly. So what increases? Cash, and what decreases? Liability. What increases? Cash, and what increases? Liability, right? What are you doing? You debiting your cash
And you're crediting
Let it
the
go up.
liability.
for it to go up.
Because liability is a credit account. All right, guys, we're talking that accounting and bookkeeping language now. Credits and
Exactly.
debits don't mean what they mean from the bank account when you're see when you hear I learned this from you last month, and I hope everybody here who returned learned from last month. When you see the terms credit and debit on your bank statements, that's from the position of the bank. That's how they see it. But when you're creating your own books, you have different accounts that are credit accounts that should always have credits, and you have debit accounts that should always be positive on the debits. And when you do something on one account, you better have a corresponding account to match that.
Yep. So one of the things that I'm doing is I'm going back, and any client that I have, just make sure that you don't have the EIDL included in income. Just because it's just not what you need to do. It's not the right thing to do. So that's on the EIDL. And talk about grants. I know a lot of people have received grants this year. So grants are usually taxable, right? However, what I'm going to tell is you want to confirm with whatever the grant donor is, just to make sure that this grant is not taxable. But grants are usually taxable.
Is the New York State Pandemic Relief Grant done through Lendistry taxable?
So that I wouldn't have much information on that. I know we can cross check that, but from what I know that that has to be reported as a taxable event. But I can confirm that for you.
Thank you.
Now, the next thing that I want to talk about, and I think somebody asked this question, is that did you make regular income from your employer W-2 and as well as have your own business?
Yes,
Right.
that was Linda Bolton. What if I worked 9 to 5 and had a contractor job on the weekend? Can I get an EIDL or PPP loan? Well, can I answer the PPP loan question right now?
Yeah.
The PPP loan is no longer available to anybody as of May 28th of 2021. The program ended on that day because it ran out of funds. Now, EIDL, take it away, Nana.
So remember that EIDL is based on 2019, right? So the person that asked the question, if you during 2019, you actually did have what we call a Schedule C, you can apply for the EIDL. The deadline for the EIDL is 12/31/2021. But remember, it's going to be based on 2019, not 2020, or 2021, or 2019 business. So once you have a Schedule C, yes, you can apply.
Linda, I hope that answers your question.
Yes, it does.
Now, I just want to highlight, Linda, okay, I'm sorry, Linda. I just want to highlight something important over here. So if you have a W-2, right, what does a W-2 do? A W-2 is reported on your 1040, which is personal taxes. W-2, salaries and wages, right? What happens to the W-2 is when you get a W-2, the federal withholding is already, your federal tax has already been withheld. That's what we call the federal withholding. The state, in box 16, that's a withholding. So depending on what you decide to elect, meaning that there's something called the W-4 form, which is going to say, okay, from 0 to 4, how much withholding do you want? 0 being the most, 4 being the least. But remember that whatever that you select is always going to come back at the end of the year. Because if you select 0 and they withhold more money and you do your taxes and realize that your taxable income, remember you said that, is actually lower than the amount of money that was withheld by the federal government, that is what leads to what we call a refund, right? So the IRS is going to say, hey, we took more money from you than you actually had to pay, so we're going to give you back that money. That's a refund, right? The same applies to the state. Now, if you do have a Schedule C and you made losses on your business, on your other side gig that you're doing, remember that the Schedule C is going to flow into your 1040, which is your 1040, your regular 1040 for personal. It's going to be able to offset some of the income that you actually made on your W-2, which may end up giving you a lower taxable income, put you into a lower bracket, and you may be eligible for more refund. So that is how it works, having a W-2 and having a side gig. However, the reason why I'm not usually a big fan of actually continue to show losses on the Schedule C is just because of the fact that businesses, if you're going to apply for a loan and they tell you that I want to see your taxes, and so that you see that the Schedule C is starting to make losses, right? That means that you're not really a viable business. That's why when you go to John and you say, John, I want to apply for a loan, the first thing John is going to ask you is, I want to see your taxes. Send me your Schedule C, 1040. That is business.
Right. I have this problem all the time. There's these businesses that have gross revenue of 150K. So they do a lot of business, but they deduct a lot of expenses and they end up with only like $20,000. And then they're like, but I need a $100,000 loan. It's like, well, you can't pay a $100,000 loan according to your taxes. You know, a lot of creative accountants out there doing a good job saving, minimizing the tax burden for their clients, but they're not explaining to their clients that if their clients want to get a loan to buy a house or get a loan to buy expand their business, they're not going to be able to. So my strategy for them is like, hey, listen, don't minimize your tax burden so much for a couple of years. Get that home mortgage. Then you can start reducing your tax burden again for a little while until you have to make the next big buy. But banks want to see at least 2 years of decent profits in order to justify lending you a lump sum of money, because they want to make sure that you can pay it. And even though you might be able to pay it, it needs to look like that on paper.
Yep. Next slide, John.
Yep. Oh, it's questions time.
All right. So, John, thank you very much. And I always enjoy these webinars with John. The reason that is that, we really try to make it informal. We really try to make it where people really walk away, really learning, like in a classroom setting, like really learning and not having what we call me talking all the time, right? Like John would say, when we did it last month and we did the debits and credits, right? John still remembers. A lot of people reached out to me saying that, listen, that was great because I really now get it. I took my accounting class and I really get it now. So I'm really hoping that people that really join this webinar really are going to walk away really feeling confident about the taxes and challenge your CPAs. I like it when my clients challenge me. Review those returns. Just make sure that you tell your CPA or tax preparer that, listen, I know what this is about. I know what the Schedule C is. I know what an itemized deduction is. You didn't make sure that my itemized deduction is more than the standard.
Hold on, I see that. I don't mean to cut you off. I just want to catch everybody before they leave. Yeah. I just put the link to the survey in the chat. I need you guys to fill out the survey in order for you to get access to a free 30-minute session with your CPA or your future CPA. Please fill out the survey. Nana, continue. And I just want to take a pause. Does anybody has any questions? Please come off mute, and I'd love to engage the audience and John as well. So, Darwin, your hand is up.
Yes. Hello, Maria. Can you hear me?
Yes.
Yeah, we can hear you.
Just take a little bit away from the microphone so we can hear you a little bit clearer.
Okay. I have a question. I did when I filed my first year for the LLC. I did file like in February, but like after 2018.
Darwin, I'm sorry, I'm having trouble understanding you. Can you step away from the microphone a little bit? Just come back a little bit.
Okay, can you hear me now?
That's a little bit better. You can lower your
Okay.
voice too. We can hear you.
Okay, so when I filed my taxes in 2018 with my CPA, I thought everything was fine because I did file in February. But after in the same year, I got a letter from the IRS saying that my CPA sent the papers in August, and they said the letter was saying that I owe them like between 9,000 and 10,000. I don't know exact number right now, but I do have the letter saying because my CPA sent it after the due date. So then my CPA said that don't worry about it. We're gonna do the first time agreement. So then we did the first time agreement, and so I don't have to pay anything. But for the next 2 years, I changed my accountant because I was just like afraid that my first CPA did not file the tax returns on time. But I always now every year I have to call the IRS to make sure if they got the tax returns on time before the due date. And that was a lot of money. And my question is, like, let's see that happen in the future. What can I do in order to like not to pay to the IRS? That's my question.
Yeah. So anytime that you go to a CPA and they file your taxes, once your taxes are accepted, it's in most taxes are electronically. 99, nobody usually do hand. They're supposed to send you the finalized return right away, right? So if you submit your stuff to your CPA, let's say in February, you need to check with your CPA, what time can I expect you to file my taxes? In the next couple of weeks, you didn't hear from them, you need to email them. So basically, before April 15th, you want to make sure that your CPA has actually sent you a PDF version of a finalized tax return with the date and the stamp of when it was transmitted. Because now, if anything is transmitted electronically, you can't lie. I mean, my client, they see right there and there when it was transmitted and when it was accepted by the IRS. So make sure that they are sending you that information, right? And make sure that you be proactive following up with them at least every couple of weeks. Get your information to them on time. By February, everybody should have had all the information. Make sure that you send that to your CPA and make sure that you get it an estimated date when you feel like, when they think you're going to be able to complete your taxes. And make sure that you get in that final return from them.
But my question is like, what can I do like in order, let's say my CPA did not send on time the taxes. So I know I'm going to get a fine between 9 or 10,000 if my accountant, CPA don't send on time. So I'm just trying to avoid that.
You just have to have a backup plan. That's what I'm going to say. Because, if like you said, good that you change your CPA, but the only thing I can tell you right off the back is that if by March 15th, your CPA hasn't given you a date, I would say just look for another one. Just make sure that you actually take it in and go in somebody who can finish it on time before April 15th. It's every CPA works differently. Some people, when they can't do it, they're going to tell you that they're going to file an extension so that, you have an extension, but just make sure that you have a backup plan. That's the only thing that I can say. John, I don't know if you have any experience with your clients or anything else that you want to add to it.
I don't. I think you're on point. It's on you to file your taxes. It's not on your CPA. You just got to have a backup plan. What I wanted to say is that we have 45 people in this room right now, and only 10 people have filled out the survey for their free one-on-one. If you want a free one-on-one, you have to fill out the survey, and then we will be in contact with you with next steps so that you can get your free one-on-one 30-minute session with a CPA. I also have a couple of questions in here. I want to call on Nieves Santasoto. Nieves Santasoto, are you there?
Yes, I'm here.
Nieves, please ask your question about the SALT limitation.
Oh, yes. Hi. First of all, thank you for hosting this. It's awesome that Nana can present this tax issues. Anyway, so we do have that SALT limitation, right, for property taxes. And so I know the Biden administration is working on having this modified. Like, for example, New Jersey has the highest property tax in America. So what I know, they're in talks right now, and I don't know when that will be approved, because a lot of homeowners are greatly affected by this limitations of 10,000 a year. So when us based on experience, on your experience, Nana, when can, let's say Biden approves this in the next let's say January, can they still make that change that would affect 2020 taxes?
Yes, absolutely. That's what happened last year. Last year, remember, was an election year, right? And
Yes.
there was a change in government, there was a change in philosophy. Accountants were like spinning around. Like one day, like, so what I did is actually waited for the last week to submit a lot of my clients' taxes, because everything that they did in that year was retroactive the previous year.
Yes.
You can expect the same this year. But the great question that you asked, also I want to elaborate on, is that remember that it's going to also take a while for whatever tax institution, the tax software, to update in order to be able to reflect those, you know, for the tax users. One of the key things that also happened, remember the unemployment situation where they came with an exempt of 10,200, right?
Yeah.
That was approved, it was retroactive, but it actually wasn't reflected till March, right? So if somebody had filed it March, what they told you to do is, well, you can either amend, or the IRS is going to amend it for you. Good luck waiting for the IRS to amend that for you. So yes, definitely. I'm following up on that, and I'll let John know. We're going to shoot you an email in case you approve. But whatever it's going to be, it's going to be retroactive. Yes.
Very good. Thank you.
All right. We're moving along. I see a few more people filled out the survey. Please continue to fill out the survey if you want access to a free 30-minute consultation. Next question is from Dimitri Prince. Dimitri, are you still there? You must be, because there's still 45 people in this room.
I know, right? I mean, it makes accounting fun, right? I'm like, okay, good.
Yes. Hello?
Dimitri, ask your question.
The question is, between the S Corp and LLC, are there any tax benefit differences up to a certain revenue threshold? Or how will I decide when I'm choosing between the two?
Yeah, so Dimitri, great question. Like we said, that is more of an individual choice. What I always say is that, and I think this is going to be a great thing that we're going to follow up on it. If you set up for a 30-minute consultation, because it usually depends on where you are as a business, right? So the benefit of the S corp really is that so basically, you get to be able to put yourself on payroll and get tax ordinary income. However, remember that on an LLC, you can also do that, right? But what the S corp is doing for you is really giving you certain other benefits that maybe else may not. But tax-wise, honestly, I don't really think that there's really any tax benefit. But I'm going to say that if you're a solopreneur, there's no reason for you to do an S corp to actually start making some income that you want to, do between self-employment, right, and ordinary income tax, right? There's always a pros and cons. So people have asked about the pros and cons, but that is going to take a further review of your financial statement to determine at what point in time makes sense. What I'm going to say right off the back, if you're looking to set up a new company, right, if you can afford to set up an LLC, I recommend you do that, because as an LLC, like I mentioned, you can always elect to file as an S corp. But if you go from incorporation to an S corp, you cannot come down to an LLC. And if you do an S corp, remember there are a lot of requirements, the 941s, the NYS 45, and all that stuff that you have to answer to. So it's not one set question, right? It's it's a little dicey. We have to like kind of look at your situation a bit more closer to determine that.
All right. We have 16 out of the 45. All right. Listen, guys, when I leave here, that survey closes down. So if you haven't filled out the survey yet and you're still here, please get to it. All right. Oh, 17. I see Linda Bolton's there, Tony Blackman's there, Terry Ann Phillip, Darwin, Trina, Ambers, Daryl, Jessica, Ruth, Martine, Jacqueline, Katriana, Regina, Shamir, Kerethria. I'm so sorry, Ms. Boyd. I definitely butchered your name. Rashida, Annalie, Tapti. You guys are in my list. Okay. You guys are in my list. So if you don't have a question for Nana, you can leave. You can sit and wait and hear more questions. Annalie, I think you're the next question. You want to talk about corporate taxes, Annalie Hendrickson?
Yeah, so basically, I'm an S corporation. I'll be filing for the first time. I got incorporated November 27th, 2020. So this would be my first time having to hire an accountant who knows corporate tax. But I know, sometimes you ask people about their background, they're a little bit dicey, they don't, everybody, oh yeah, I have that experience. You find out later on they don't. So I'm just trying to find out what are some maybe checks and balances on my part I can do, or maybe some red flags I need to look out for when hiring somebody, and to know that they're competent. And if something bad did happen, how do I figure that out without
Annalie, let me stop you right there. Real simple answer. Just hire Nana.
Okay.
Like, you just asked a whole bunch of questions. I can give you the answer to that one. No, I'm playing. Nana, go ahead. What are some things she could look for to make sure that she's not talking to somebody who's just fronting like they're a real CPA?
Yeah, Annalie, it's a great question. First of all, I think the first thing that you want to be able to do right off the bat is ask them how many businesses that they have that have S corps, right? They should be able to tell that right off the bat. And the
Right.
second thing that you want to be able to understand is that, what do you need from me? What do you want me to provide so you can get all the information that you need,
Mhm.
right? There should be, the first thing that should come off their mind is going to be a balance sheet and your P&L. You need that for the S corp, right? They're going to ask you for your S corp, election, right? When the S corp, so when the S corp was formed, right? Have you filed any 941s, right? So are you on payroll? Did you make any income? So those are the questions that they want to start asking, because they're trying to gauge to find out, first of all, if you're in compliance. Second of all, if they're filing and they're doing the K1, are you going to make losses? In that case, you're not going to get penalized, right? So, and they also want to ask you, how many shareholders that you have. So those are really basic questions that they need to request from you. Else, if they don't request that from you, they can't file those taxes, right? So just the little basic questions, just for them to get the information that they need in order to file those taxes.
Okay, thank you. And when at the end of the tax year, should I expect, I guess, two separate things in the mail, like individual versus the corporate paperwork that was filed, or one statement will come to me at the end of the year?
So everything is electronic, right? So what happens is that S corp on March 15th, they are going to do your S corp for you, right? It has to be electronically filed. If they're not going to electronically file for you, I think at this point in time, last year there was a bit of complication because the IRS had not processed a lot of the returns then. But this year, since you say it's November 2020, that was a year ago, you should have in the system as an S corp, right? So March 15th, they're going to do that. They're going to send you what we call the K1, right? You're going to have the K1. If the same accountant is doing your personal, they're going to use the K1 to file for your personal tax return, right? So everything, you shouldn't be mailing in anything. The only time that you're going to mail in something is if you owe money and use the voucher to mail in something, but everything has to be electronic. Unless the only time that it's not electronic, I came across a couple of those situations last year, as the IRS didn't have you registered as an S corp, and for some reason they can accept your returns electronically.
Okay, so I should expect, they'll, I'll receive my corporate taxes back, and then that's going to be used to do the individual ones to make
Yes.
sure everything's accurate. Okay, thank you.
Annalie, most important thing, just make sure you do it as quickly as possible, because you don't want to be sitting there waiting to do your personal taxes because your corporate taxes aren't done. Now, me, I don't like to wait, right? So I get my taxes done February 1st. Once I get because I have my W-2s and I have my Schedule C stuff, and I know that I need to get it done ASAP. So the minute I see W-2s or any 1099s that come my way, the first thing I do is write to my accountant. My accountant is doing my stuff. By March, I already know if I'm going to pay or if I'm going to get paid. I like to get paid though, so.
Thank you.
All right, you're
Good
welcome.
one, Annalie. Okay, so let me just do a survey check right now. I have Nicole Smith, you're in there. Amanda, you're in there. Dimitri, you're in there. Shakasia, you're in there. Detria, you're in there. Sharonda, you in there. Peaches Avian, you're in there. Sabrina Scott, you're in there. I still have 32 people in this room though, so there's no way I have 32 names on this list right here. If you haven't filled out the survey, please do. Okay. Next question.
Can you put up the contact information again, please? Like that slide. I think there was a slide. I didn't get it, or it's not in the chat.
I will share the slideshow immediately after this, Annalie, but I will go to the slideshow right now and give you the contact information as well. Okay, so just give me 1 second. Blow. Just for you. There you go. Are we all good?
Awesome. Got it. Thank you.
Have a good night, Annalie.
Thank you.
All right. So
Okay.
let's see. Who's in here? Who's in here? There's still a lot of people in here. Wow. Let's see. Ms. Boyd, are you there? Can you come on and just tell me how to say your name correctly? Because I really don't want to do that again. Yeah, you're here. Let me ask you to unmute. Ms. Boyd, unmute. Let me know. How do you say your name? Nope, she's not going to join us. All right. Let's see. The recording will be shared, everybody. I just have to, once I get the recording, I have to send it to our communications team. They will edit it, make sure it all looks pretty, and then we'll put it on our YouTube channel, and I will share that with everyone who showed up today, okay?
I'm here. It's pronounced Karitha.
Karitha.
You can call me
Okay.
K for short.
I'll tell you what, I'll double up on that. I'll call you KK. You good?
Oh, wow. Now I'm back in high school. Great.
Hey! All right.
John,
All right. Yes, Martine.
can you please put the picture that you just put again so I can take a screenshot of it? With
Oh,
the
you
link?
want the wait, hold on. I'm sorry. Do you want the contact information for Nana, or do you want the link for the survey?
No, the one with banana.
Okay, you want Nana's contact information. Give me one quick second, okay?
Thank you.
There it is. Nana, we're keeping you busy.
Thank you so much.
All right. All right. Thank you, guys.
Okay, I'm doing 5 more minutes, guys. 5 more minutes. I'm holding Nana hostage. 5 more minutes. Please finish your survey. Please finish your survey. All right. Anybody else have any questions?
Yes, I have a question.
Miss Amber.
Yes. I'd like to ask Nana, what are your thoughts on establishing an LLC, but to avoid the expenses of New York City publication costs, establishing it in an outside county and relocating it? Is that frowned upon? Is that something that cannot be done? Does it need to be done within a certain time period?
You trying to come to Westchester?
Possibly.
Yeah, so that's
Whether I don't have to pay.
Now the publication costs in New York City are really high because it's random, right? You don't know where you're gonna have to publish. You might have to publish in the New York Times, or you might have to publish in the New York Post.
Exactly. So is that something that is frowned upon? Is
I mean, so far as you
state?
publish it in New York State, that should be okay. But not outside of the state, right? Because remember that
Correct.
if you're doing business. But one of the things that I'm going to tell you that New York City does is that if you make any income in New York City, right, they're going to find a way of getting their money back, right? So I always find it easier that the address that you use has to be the physical location of the business, right? Because if you use another one, because one of the things they're going to ask you is what county or what county or what district are you in, right? So, for instance, the borough is Kings County, is Queens, it's going to be Westchester, right? And the address usually the address of the business has to really match that, right? So there are all these complications. So I just want to make sure you're being consistent. If the business you cannot give a New York City address and be doing business as of New York City. But in terms of the publication, people look for somewhere in Albany or whatever it is.
So Miss
But
Ambers,
I can always relocate it.
Miss Ambers,
Yes.
look for a co-working space in a county that's very cheap, and register your business there.
And then relocate it.
Well, no, you have
No.
to stay in that location in
Yeah,
order to file the taxes.
Wait a minute, wait a minute.
Like Nana said, if you relocated, like say you came to Westchester County, registered your business there, but then moved it to Brooklyn, New York City is going to come at you for that New York City tax.
Okay, New York City will come at me for the New York City tax. That I understand. I don't know what that would come to, but that I understand. But if, my first thought was I was looking at the publication fees just to avoid that. And that's why it's about the relocation.
Okay.
Because I would not have to republish with a relocation, correct?
No, I don't think you have to republish.
No, you don't have to republish. The publication is a New York State thing, right? It's a state thing, not really specific to city, right? What we're talking about is city taxes. But if you're talking about publication, people find some. I know that there are certain agents that they're somewhere in the middle of nowhere, like purchase, like I would say Albany or whatever it is, and they just do the publication over there, right? But your agents that you use has to be domiciled in that. Remember that the agent that you use has to actually be within that county or whatever that you're trying to do a publication in, right? Because then they know what newspaper to put it in and all that good stuff.
All right. So we had 45 people. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28. I have 28 people that have filled out the survey, but 45 people were left. So that means not everybody has filled out the survey, and you have 1 minute and 30 seconds to finish filling out the survey. Please make sure that you fill out the survey in order to get this. If you're calling in over the phone and you can't get the survey because you're over the phone, email me and tell me what phone number you're calling from so I can verify that you were here, and I will send you the survey to fill out. In the meantime, 17 people still here. All right. So
Nana, quick question. Would a registered agent also count for the residency question for the woman that asked the question about avoiding the higher fees in terms of LLC publishing? Would a registered agent count?
Yeah.
Like if listed her business through a registered agent?
Yeah, they definitely would. I have a lot of these registered agents are actually not in New York City, to be honest with you. They are in some remote place in New York State, and they find a local newspaper right there, so they do help. Yes.
So she doesn't necessarily have to get a co-working space. She could just use the registered agent.
Yeah. The only that's for publication. Remember, let's just separate. That's for publication, right? But then when it comes to the taxes itself, where you will register your business, right? If your business has a New York City address, you go to pay New York City taxes, right? For publication in state, you can publish it here.
Right,
Okay.
taxes, you definitely have to have a physical address, not a registered agent. Okay, thanks. Thanks for clarifying that.
Okay,
Thank you.
no worries.
Hold on a second. Nieves, you're having issues with the survey, you're saying.
Yes.
I don't know why that is.
So I have a question from Mr. or Mrs. Pierce, saying that I started my LLC in January 2021. So the great thing about an LLC, I'm going to cut right off the back, is that you don't have that requirement as an S corp, right? So the only thing that you need to do is file your annual taxes, and you're good. You just file your it's part of your 1040. So that is not going to be applicable to you, Mr. or Mrs. Pierce. Or you can come off mute if you want to, but.
Hi, yes, thank you. I'm looking forward to the consultation. Like, this was an excellent presentation. I've been in like webinar mode all day learning about stock stuff. So this is a good way to kind of wrap up my evening. Like, I have a lot of questions pertaining to my type of LLC because I want to do consulting work. So I think I'll be getting paid like, you know, directly or try to gain contracts and stuff like that. So I just want to make sure that I have the right like type of checking account and stuff like that to make sure that everything
Invoicing
is,
system.
yeah, everything. So I'm definitely looking forward to that one-on-one. Like, you guys are
Great.
amazing.
Great. Looking forward to it as well. Thanks.
Nieves, I don't know why it's asking you to use your personal email. I have it set where any email can be used. So if you need to, we can talk offline and I'll set you up, okay?
Okay. Thank you.
Do me a favor, can you text me your email address and I'll set it up with you?
Okay.
Okay. All right. Ladies and gentlemen, this is now the conclusion of our one-on-one today. I hope you enjoyed it. This is all for you guys. I appreciate every single one of you, and I hope that you get the most out of your time with Nana. Come with questions. Be ready. All right. Let me see. As they... Okay. All right. People are exiting on their own.